Welcome to a continuation of the discussion of mutual funds and other investment companies. This is Dr. J. Kent Gregory, and I'm following Jordan Miller and Dolvin's Fundamentals of Investments, ninth edition, McGraw-Hill 2020. And in this section, we'll talk about stock and bond funds, closed-end funds, ETFs, and ETNs. So stock and bond funds are also known as blended or hybrid funds because, as the name suggests, these funds invest in both stocks and bonds. And there are five main types. There are balanced funds, which maintain a relatively fixed split between stocks and bonds, and they focus on safe, high quality investments. And then there are asset allocation funds, and there are two types of these. The first type, like a balanced fund, but it holds relatively fixed proportions of stocks, bonds, money market instruments, or even real estate. And then the second type is referred to as a flexible portfolio fund. And in this, the fund manager may hold up to 100% in stock, bonds, or money market instruments, depending upon what he or she views as the potential performance of those instruments. And essentially, the fund manager is going to try to time the market with the flexible portfolio fund. Then there are convertible funds. So some bonds are convertible, meaning they can be swapped by the bondholder for a fixed number of shares. Then there are income funds, and these focus on dividend and coupon income. And then finally, there are target date funds. And these are very popular in 401k and 403b vehicles. They're also known as life cycle funds. The asset allocation in these funds is chosen based on a particular retirement date. So it may start out with a heavy allocation of stocks. So it started a little bit more risky, a little bit more growth oriented. And then as the years progress and as the target date approaches, it will gradually shift in terms of its makeup to more fixed income investments. So it'll become gradually more conservative as that target date approaches. Closed-end funds, some basics. So remember, closed-end funds don't buy and sell shares. Rather, there are a fixed number of shares in the fund, and these fixed number of shares are bought and sold on the market. So note particularly figure 4.6 on page 119 of Fundamentals of Investments. If you look at that, you'll note that essentially all the closed-end funds have premiums or discounts. And then the premiums and discounts can actually be relatively large. And in addition, the premiums and discounts can fluctuate on these closed-end funds. So let's consider an example how one's really got to be cautious when it comes to investing or considering investing in or considering a closed-end fund. So suppose a closed-end fund is created and it raises $50 million by selling 5 million shares rather at $10 per share. And note that this is the fund's NAV, so the $10 per share. There's a catch. The fund promoter will take, for example, 7% of the proceeds right off the top. So this 7% equals 3.5 million, and it's 0.07 times the $50 million. So this fee comes out of the fund, reducing the total value of the fund to 46.5 million and an NAV of $9.30, so which is 4.6 million divided by 5 million. And then the shares themselves that now have an NAV of $9.30, not the $10 that you paid, could also trade at a discount. So the moral of this is that newly offered closed-end funds are generally very poor investments. And then there are the popular exchange-traded funds, also known as ETFs, and these are very popular with day traders. So to talk about ETFs, they're essentially index funds that try to achieve the same returns as a particular index. So, for example, the Russell 2000 or the S&P 500. However, they trade like a closed-end fund. So they can be traded throughout the day, they can be shorted, and they can be optioned. They generally have low expenses, but you must pay commission when you buy and sell. And they have low expenses because they're very passively managed. So something that's interesting to note is the creation of an ETF. So when creating an ETF, a sponsor, for example, like Fidelity Investment, files a plan with the SEC. The sponsor sets aside the shares in a trust. Then creation units are formed. And these are essentially like claims, like a coat check when you go to the theater or the opera, on bundles of shares held in the trust. So the creation units are typically for 50,000 shares, and these are then split up to be sold on the market. So the ability of investors to redeem these shares keeps them from trading at a discount or premium from their NAV. There are also leveraged ETFs. So by using derivative contracts in the ETF, the fund manager can magnify or leverage uh, the return on the underlying index. Let me, this is supposed to be the return. So leveraged ETFs can be increasingly more volatile the longer they're held. So these are not essentially meant to be held for a long time. So short. Uh, there we go. If I can get that T in there. Sorry, that wasn't very good, but there we go. And finally, a final note, there are exchange traded notes, also known as ETNs. They were originally created to provide exposure to risks or opportunities to take advantage of the risk and returns of commodities. So ETNs now exist for currencies and an emerging market. This market is India, which makes sense. Uh, and ETNs are debt securities issued by respective sponsors, for example, Barclays Bank or JP Morgan. So, but ETNs are unsecured debt securities. So the investor relies on the solvency of the issuer. So relies on the solvency of, say, Barclays or JP Morgan. So ETF owners, however, own a fractional share of the shares placed in the trust. So these are ETNs are a little bit more risky than ETFs. So that concludes our discussion. I hope you enjoyed that and that you learned a lot. Thank you for joining me.